Welcome back, traders. Hope you had a good Easter weekend. ICT just put out another lecture. This one is called Turtle Soup, Deferred Entry with Rejection Block. Now, turtle soup, in my opinion, is one of the harder types of entries to do. It can be hard to know when the right timing is to enter and where to put your stop loss. So maybe ICT will give us the answers in this lecture. Please give this video a like and subscribe if you haven't already. I will be giving my own commentary, but as always, the original video is linked in the description.
All right, so we are looking at the 5-minute chart on NASDAQ, June delivery contract for 2025. This morning, I was outlining, I had very low expectations, admittedly. Usually, I have my protocol for trading after a holiday. And even though markets were trading last week, I was not participating in any of that. I was fasting from the markets, if you will. I like to give it a like 1 day buffer. So today I showcased a execution, and you're going to see it again here. Just for disclosure's purpose, I am going to let you know that it was not a live fund account trade. So because it's within keeping the rules and processes and protocols I follow, this could have very easily been a day where trading this setup would not have yielded an outcome like this. So because I am a stickler for principles and rules when I'm trying to teach it to you all, again, just know that the money that you see here today shown on this particular trade was done through the medium of a paper trading account through TradingView. So we're looking at the June contract 5-minute chart, and I showcased in my Telegram channel. We're going to look right in here. There was a couple things I had already outlined, which were this large SIBI for the new week opening gap. So here's the new week opening gap high, new week opening gap low, and the consequent encroachment in lower and upper quadrant levels. And then we worked away from that. We had a inversion fair value gap here, trading up into the 6:50 to 6:10 a.m. Eastern time macro that supposedly never exists. We have buy side relative equal highs here and a volume imbalance. Really, really easy anticipation running up into that. And the market broke aggressively lower. Now, if it was not a day after the long break from trading, from not participating or even watching price during the Passover week last week, then I would have actually taken that trade. Like that would have been an easy, low, a low difficulty trade setup. And I would be looking for this level here, which is an old hourly low. I'll show it to you in a moment. And then I may have been more inclined to hold on to the trade for a little bit longer instead of just a small little move that I was looking for and you watch me do on the X. So the market, again, breaks below this low here. And I've taught breakers, obviously. You can go in the 2016 ICT mentorship playlist. And for month 4, I teach the breaker as an introductory there. I've done lots of lessons and built on it since then. But this is the candlestick that is my bearish breaker. So technically, what you want to see is the last down close candle prior to a run higher. And these highs here, buy side, lowest low before this high takes out that buy side, and it trades up into a premium array.
So same as ICT, I did not want to trade the Monday after the holiday weekend, but I was looking at the chart and I saw how price was respecting bearish PD arrays, and with this drop at 7 a.m. I thought there was an opportunity to get short as long as sell side targets were not traded to. It did go through this 116 target, but there were 2 more below, one at 70 and then even lower at 17,918. So personally, I was looking at this second SIBI, which lines up with this down candle. I was looking at this as a breaker from this high, low, higher high. However, I can see why ICT is using this as a breaker, because the first high, you want that to be the pool of liquidity that gets taken out with the higher high. So I don't know if ICT is going to mention this or not, but I'll make sure to keep this in mind when looking at breakers in the future.
I mentioned how I walked through this buy side imbalance, sell side efficiency right here, which is this volume imbalance to that candlestick's low. So all this shaded area is a buy side imbalance, sell side efficiency. But when the market provides this context where it trades through it, this changes to a inversion fair value gap, bearish inversion fair value gap. Why? Because this was buy side imbalance, sell side inefficiency. If it was a bullish market, it would come back down into it and hit it like it did here, and then rallied up to the premium array. But since we broke down, keeping with the bearish market. So when we traded below it, I outlined this when we were trading here. And you can see that in the Telegram channel. It trades up into it, trades the consequent encroachment just a little bit above it. The body's respecting the low end of it, and it's traded down lower. And then right in here, I said, okay, hypothetically, you would pay the trader. So that was a pre-session setup that I outlined during the Telegram channel. But Obviously, we know during the opening, the market can run short-term highs and short-term lows. So if the market's bearish, and we had relative equal lows down here, you can see how the market did in fact run up. But look at the bodies. See that? So we had all this damage done with the wick. And then this wick here basically is consequent encroachment of that. I have taught this in 2024, tongue twister, 2024, ICT mentorship on my YouTube channel. You can see it's just perfect delivery. It's algorithmic, okay? You're gonna tell me that buyers and sellers agreed to stop transacting right there at the consequent encroachment of a level on a wick, which is premium PD array. So because we have this idea here, and it's likely to run the 18,080 level, which to me was a very easy, low-hanging fruit objective, very easy, simplistic, nothing crazy about it. It could have just went down here, take out that low like it did here, and then traded, banged around a little bit and didn't do anything. That would be a classic type of day after a Passover / you may call it Easter break from the normal volume that comes in the marketplace. Alrighty, here we are on the 1 minute chart. You can see on this candlestick right here, it runs up after opening, runs up, hits the consequent encroachment of the 5 minute premium wick, stops dead in its tracks, and then starts to displace and go lower. My eye is toggled onto that right there, that closed candle. Now, what am I looking at that for? Why am I watching that? Because we've already shown the initial run into that inversion fair value gap in this one right here, and then we went lower. So all of this was outlined before the fact. And then at 9:30 opening, the rally up into the clear, the pre-session stops for anyone that's already short. Classic scenario, classic. So this inversion fair value gap gets used again. But I wanted to wait and see because of the nature of the marketplace. Even if it was a demo account execution, I still wanted it to be nice and clean and principally based. So as it left trading below it, I'm trying to wait and time it when it hits this closing price. So I want to show you like this. So here you go. That is the rejection block. It's a bearish rejection block. And right there, just like that. Okay. So as price is dropping down on the 1 minute chart, as it does that right there, it's doing two things. It's leaving the inversion fair value gap, this, after proving that the consequent encroachment of the 5 minute wick stopped price in its tracks. And look at the bodies here. Every body is higher, rejection, algorithmic destruction. If price takes it outside of the inversion fair value gap, and as soon as it hits this level here, the algorithm is going to start spooling. Okay, I'm not going to go any greater detail here. I promise you in the book, volume 1, I will talk about this very thing right here because this is a deferred entry to a turtle soup, false breakout, higher high reversal pattern. Okay, so I try to cover every possible scenario that you may be familiar with the general principle of a buy stop raid here. The premise behind it, a stop hunt, stop raid. It's just a beautiful little mechanism of entering a trade, but you have to know what the narrative is. And if you don't know what the narrative is, you're going to get lost in the sauce. You're not going to know what you're looking for. How are you going to pick? What are you going to aim for as your entry mechanism? How do you know it's not going to keep going up? Well, that's what I teach. I teach narrative. I understand how far it's going to go. And I gave this inversion fair value gap before the opening bell. But true to form, look what it does. The wicks are allowed to do the damage, and that doesn't matter to me. I'm looking for how those wicks are laid down. And then I look for this type of scenario here, which is what I taught in 2024.
So if you remember, I was looking at that 5 minute CIBI, which is pretty much here above his inversion fair value gap. Now, all of these 1 minute candles wicked into the CIBI, but didn't leave any bodies in it. So that led me to think about taking a short with the stop loss at this 1 minute swing high. Of course, I didn't take it. I just thought about it. But I'm not even sure if having the stop here is the proper way to trade turtle soup. Maybe it should be a little bit above in case we decide to sweep the buy side one last time. But ICT here is explaining this deferred entry on this rejection block. Now, I don't think he's ever talked about this before, and it's not even clear to me as to why this is the chosen candle for this rejection block entry. Honestly, I don't really see myself using this in my own trading, but each to their own, and of course, this is ICT.
So anyway, that's the business there. The market rates down, takes out the relative equal lows. This is a minor sell side liquidity pool, and then finally that right here, the old low in the morning session. So what I've been doing, in case you haven't noticed, is just for the morning session, if I'm operating inside the pre-session or during the opening range or the first hour trading, that's kind of like that small little area of opportunity I've been focusing on for this year's executions. And sometimes I'll do trade setups in other time frames. You see me trade London now. You see me trade Asia. You see me trade the PM session and the afternoon New York session. But really, my focus has been primarily trying to get you to focus on just a small little window of opportunity that's framed by time and looking for very, very simplistic things that repeat. And it's been a pleasure this year just showcasing it without a doubt, proof before it happens, the very PD arrays. Because let's take a look at the setup. I'm only showcasing the moves that are basically working inside the first 60 minutes of trading. And if you showcase this here, you can see that this candle right there, and I'm targeting right there that rejection block, and I'm doing it on a market order basis. So it's not going to be perfect, but that's what I'm aiming for. Okay, and then obviously the low over here, you can see it gets filled below it there, and then it comes right back up to the old hourly low, which I will show you in a moment what that is. Trades up into the volume imbalance here, and breaks lower, takes another low out there, trades one more time up into the old hourly low, and then they send it. This move here, this is not what I'm trying to give all of you this year, because this is Robin's Cup winning type setups, and I'm not trying to spoon feed that. I know that there's two guys that are basically following along what I'm doing, and you got to get your own honey, buddy. You can't be in there getting it from me, and then you wonder why they're slipping on the leaderboard because ICT turned the valve off. All right, so okay, but we're seeing it obviously break lower. Then we had some buy side liquidity here that took that and broke lower. And again, the same thing in here. Right there, sell sign of balance, buy sign of efficiency. When it's a wick that overlaps it like that, that means they're going to revisit it again. And you see it there. Beautiful. Look at the bodies respecting that. Okay. Again, this is one of those. How do you know which fair value gap ICT? Well, first of all, number one premise is time. Why should it form where it's forming? Two, where is it in the context and narrative of the day? Is it profile going to be a trending day? It's going to be consolidation day. It's going to be reversal. And if you see the fair value gap that has a wick laying over top of it, okay, you see that body right there? None of that candlestick's body is laying anywhere inside of that fair value gap. This is going to be revisited. In other words, like a reclaimed fair value gap. 90% of the time, it's going to happen. 90% of the time, it's going to happen. So you can see it respecting it there. Now, everybody else would see this, okay, a la Lori, crowd and all. They're going to say, okay, well, this is done. No, it ain't. You know what you're talking about. So the market rallies up, wicks up to the high end of it, and then you have the opening right at that low of that fair value gap, and it stops dead in its tracks right there and sends it lower. And we're going to attack low down here, which is sell side liquidity. Market breaks lower. One more attempt to get in here. What's it hitting? The breaker. This candlestick here? No, it's the lowest down close candle. Watch. And you use the entire range, not just the body. Sometimes you use the wicks, not when it comes to breakers. And there you go, you see it beautifully trading there. It sends it lower, relative equal lows, breaks lower. And now we left these here. And now we've come off of that into the close, murder on close, if you will. Okay, so this right here has been left, which I like that. So this might be something overnight. It might be something for tomorrow. Just have that in mind. And just so you know, for completeness sake, there it is. We're looking for 17,700 and just below. Okay, so that's the level I'm going to be watching for this evening. If I wake up there in London, I'll take a look at and see where we're there. And then tomorrow's trading, again, that's what we're looking for as something to draw us down into that. If it doesn't just completely do it after 4:30 when early trading hours are completed and the settlement finally finishes. The markets are all over the place, folks. The volatility is off the charts.
Okay, so this one was pretty good. I'm glad it wasn't just him showing off his paper trade. I didn't quite get the deferred entry with the rejection block. I'll have to go back and watch it again and see if I can figure out why he picked that specific candle. Now, he never showed this hourly sell side, but if you go to your hourly chart, it's a significant swing low. I'm sure you can find it on your own. Also, 90% of the time, fair value gaps get revisited if only a wick goes through it. That seems a little off to me, but I've never done any back testing on that. Just make sure you take note of the time, and that's probably a key factor in this concept. But that's it for this one. I didn't have much to say this time around, but if you have any questions, let me know in the comments. Also, please like and subscribe if you took something away from this one. And until I see you guys next time, safe trading.